Bitcoin, you mine Bitcoin through the proof of work. With gold, you mine gold by digging in. Well, in fiat, don't actually make more fiat money by printing the dollars. The printing happens after the dollars have already been created digitally. But how do the dollars get created digitally on people's balance sheets? Through lending.
Today we are going to talk with a very renowned Austrian economist, Saifedean Ammous.
When we start thinking about the future, we delay gratification, we start accumulating savings, we accumulate capital, we produce for the future. Moving off gold to fiat money is reversing the process of civilization.
It's also happening that governments are getting more involved in Bitcoin.
If it continues to happen another 10, 20, 30 years, who knows? The size of Bitcoin cash balances, I think, are going to become the largest cash balances in the world. At which point it becomes the most saleable good. At which point it has the lowest bid-ask spread.
The US dollar has suffered a huge cumulative inflation.
The people that might think of themselves as being against the US invading Iraq, against the US running military bases all over the world and invading the world and being the world hegemon, well, that's only because of the dollar that you want to keep abusing. And if you take that away, your system doesn't work. I think the examples of collapse in demand will come as a result of an increase in money supply.
Hello everyone, welcome to a new podcast episode. This is a podcast episode hosted by the University of Esperides. As you know, this is a Spanish university that offers online master and undergraduate degrees, official within the European Union, in different topics such as economics or also Bitcoin. And I am saying this because today we are going to talk with a very renowned Austrian economist that was started to be known thanks to Bitcoin, but afterwards has developed much more his own works on economic theory. I'm referring to Saifedean Ammous. Welcome to the podcast.
Thank you for having me. Pleasure to be here.
It's a really pleasure to have you here. Well, you have released your last book in Spanish with Deusto, available for everyone. And this is a book on economic theory, introductory book on economic theory. And it's a book written on the tradition of the Austrian School of Economics. So let's start talking about the Austrian School. How would you distinguish the Austrian school from other economic traditions of economic thought? Because, I don't know, ideas such as utility, capital, time preference, all those concepts are already in some sense incorporated in other schools of thought. So when you say, or when I say that we are Austrian economists, what are we referring to?
Yeah, that's a great place to start. And that's how I start my first two chapters of the book. The first chapter of the book is titled Human Action, which is the name of the famous book by Mises. Mm-hmm. And it's a great book, but one of the reasons that I wrote this book is because, honestly, even though it's a great book, it's a very difficult read. I don't feel comfortable telling my brother or my friends who ask me about Austrian economics to tell them to go and read hundreds of pages of Mises of Human Action, even though it's very good, but it's very dense. And a lot of it gets into too much of the details of academic debates, in a sense that is, it's good and it's informative if you're an economist. But if you're not an economist, some of that might seem like not the best use of your time. So I thought what motivated me to write this book is to try and express these ideas in a way that is much more palatable for the modern reader. So chapter 1 begins with explaining why Austrian economics is so associated with the idea of human action. And I think this is really what distinguishes it from mainstream economics or other approaches to economics, in that the analytical unit and the way in which you analyze economic ideas from the Austrian perspective begins by analyzing human action. Mm-hmm. I think the way that I like to think about it is the whole planet is just inert matter that doesn't do anything and is completely uninteresting in an economic sense until human beings begin to value it. So when humans value it, they work with it, they turn it into productive capital, they make goods out of it. That's when economics comes alive, effectively. That's when that matter comes alive from an economic perspective. And so if you want to understand economics, you have to understand the actions of humans involved in this process. So this, I would say, distinguishes the Austrian school from other approaches which try and understand economics through thinking of abstract units and trying to relate them. So, for instance, in modern economics, they look at mathematical aggregates and they try and develop relationships and rules that say, if this aggregate goes up, then that aggregate goes down. If unemployment goes up, then inflation goes down, or something like that. And I don't think there's a solid foundation for making these kind of claims, because the physical forces of the universe that move things around are ultimately directed by human beings. They're not directed by an aggregate that we measure in government statistics office called unemployment or inflation. So the universe doesn't owe us to behave in a way in which these statistics measured. That, I would say, is the first point, that your analytical lens is through how humans act. And the second point, I would say, which is the topic of the second chapter, value, is subjective valuation. From economics, from the Austrian perspective, is all subjective. Value is a subjective thing. Value exists only inside the mind of man, as Karl Menger says. Whereas in other approaches, economic valuation is done in an objective way, which therefore allows the other approaches to put mathematical numbers on it. And so therefore they can talk about valuation in terms of strict or precise numbers. This thing is valued this much, which makes it a lot easier to do mathematical formulas and calculations. So, and herein becomes the difference in terms of methodology becomes more pronounced, because from the mainstream perspective, from the predominant perspective of most economic schools of thought, you perform analysis on with mathematical quantities, and you assume that valuation is objective, and therefore you're able to perform mathematical formulas, and you're able to have, or at least they claim to be able to have, the kind of scientific certainty with the economic relationships. So when you present the Austrian perspective as saying, no, we don't think that value is objective, so you can't put a number on it, and you have to only think of it as being ordinal rather than cardinal, then, for most people today, it seems like it's going to be a lot less fun, because where are the numbers? Where's the math? Where's the equations? Where are the equations? But I think it's better to have a humble goal that you can achieve than to have a much more unrealistic and grandiose goal that you cannot achieve. And I think if you look over the last century, macroeconomists have not produced a single scientific formula in macroeconomics that can be tested and has withstood falsification. Nothing. So we don't, one of the most famous one is, like, let's say the Phillips curve, which says unemployment and inflation have an inverse relationship. If unemployment goes up, inflation goes down, and vice versa. But we've got now 60, 70, 80 years of data from all over the world, and if you plot it for most countries, it does not look like a downward sloping curve. It just looks like a blot of random points. Some years you have high inflation and high unemployment. Some years you have low inflation, low unemployment. Some years it's in the middle. And this trend does not exist. And that, in disciplines where math is used in a way that is not invalid, you only need one observation to falsify a rule, In chemistry, and I compare this in my book to the ideal gas law in chemistry. PV equals to nRT. So pressure times volume equals to N times R, which is a constant, times the temperature. So this shows you that there's a relation between pressure, volume, and temperature. And this is held for hundreds of years now. And all it would take is one scientist somewhere showing that, look, I put these gases and I messed around here and there and I did this and that, and the equation doesn't hold. One person does that once, that's no longer a law. It's no longer the ideal gas law. But of course, in macroeconomics, as I like to say, fiat money means never having to say you're sorry or wrong. And so we can continue to have endless number of observations of high employment, high unemployment, high inflation, low unemployment, low inflation. And yet we still teach that in the textbook at universities. So I don't think that's useful. If it wants to pretend to be scientific and mathematical, it needs to really prove itself, and it needs to subject itself to the same critical inquiry that is the topic of the natural sciences. But you don't have that. So I think, I started off being a regular economist. I studied these things, and I was alienated by the fact that you didn't have that kind of certainty. You didn't have that kind of ideas. And that's what drew me to the Austrian school. Initially, it might sound like there isn't much to be gained from just philosophizing and talking about things rather than making equations. But I hope from this book that I would make it obvious to a reader that you will learn a lot more useful things in terms of economics than if you would spend your time trying to make equations work.
You have directed some criticisms against some of the established knowledge on some topics of macroeconomics, although those topics are already also debated within the academia. But of course, you have directed some criticism. Let's if you like, let's do some exercise. I will talk you about some school of thought, and you can tell me what you consider is the most important mistake that the school of thought is committing, and what that school of thought should learn from Austrian economics ideas. How should they review their own conceptual framework? Let's start with Marxism. What do you think is the worst mistake committed by Marxist school of thought, and what ideas of the Austrian school should they incorporate?
Okay, that's a very, very big question because, Marxist school of thought has not left a mistake that they haven't done.
No, but if you had to choose one.
If you had to choose one, I think the fundamental building block upon which all of the faulty thinking of Marxism is built is the idea that the capital owner exploits the worker. I think this is the starting point of Marxist economics. And from the starting point, if you start from this, you're going to end up in very bad places. And it's going to end up in bad places analytically and also in terms of the consequences of applying those ideas, as we saw throughout the 20th century. And the key problem here is this idea that they start off with the idea that the labor is what creates value. So it's the labor theory of value. Value comes from labor. If we didn't have workers, then value wouldn't be created. Therefore, it follows necessarily in their logic that the value is created solely by the worker, which is not a logical consequence of that. So yes, we can't have value creation if the worker isn't creating the value, but we also, in many cases, cannot have value creation without capital. Yes, it's possible for a worker sometimes to create value without capital. It's not possible for capital to create value without a worker because capital is inanimate. Yet that doesn't mean that the worker is the only thing that creates the value, because a big part of the value that is created during the process of production comes from the capital. And so my favorite example of this is, imagine a worker who drives a car as a taxi, and he gets the taxi from somebody else. Imagine trying to do that job without a taxi, without the car. You'd have to carry people on your back. So think about the productivity of carrying people on your back versus the productivity of driving a car. You can, in an hour, drive 60, 80, 100 kilometers, whereas on your back, and you can drive 5 people for 100 kilometers in an hour, whereas on your back, you probably walk for 1 or 2 kilometers. So the productivity is something completely different. And that's why we don't see taxi drivers in the time of cars going around saying, I'm going to stick it to the capitalists. I'm not going to let them exploit me. I'm going to drive people around on my back. They willingly take the job with the capital of the taxi driver because it increases their productivity enormously. So once you accept the fact that the worker is better off because he's able to use the capital, then the idea that the worker is being exploited falls apart. And I think it also falls apart because, the productivity of the productivity of the worker is increased, but also there is the perspective of the Marxist as well is that the capitalist just has capital because we wake up one day and God gives you capital, but He doesn't give me capital, and now I have to work for you. I think that's because Marx never understood money and never worked and never had capital. He used to live off of rich people who financed him to write his nonsense. He never quite understood what it takes to have the capital in the first place. He never could realize how high the cost of capital is. So first of all, in order for that guy to be able to give you the car that you would drive, first of all, he has to have earned that money to be able to afford the car. So he may have done work, or he may have done some other kind of investment that earned him the money. He has to have that money, and he has to decide to put it in a capital good rather than consume it. He could keep the car as a car for fun. He could sell them. He could have, instead of having the car, he could buy a bigger house. He could throw a party every weekend for his friends with the money of the car. He forgoes all of those things. He forgoes all of the consumption that he would want to consume in order to make the capital available for the worker. And so if the worker is exploiting, if the capitalist is exploiting the worker, you could also say that the worker is exploiting the capitalist, because he's preventing him from throwing the party for his friends and forcing him to put the money in the car so that the worker would drive it. But of course, neither of them is exploiting the other. They both willingly work in this because it's a beneficial arrangement for the two of them. Allows the driver to be more productive, allows the capital owner to earn a return on his capital without having to work himself, so he can dedicate himself to other things. So it's a mutually beneficial relationship, and understanding that explains why this relationship happens, why it has been so common throughout human history. Why do people at all times and places make this arrangement? I have machines, come work with my machines. I have a car, come drive my car. And so once you do that, then the entirety of Marxist economics falls apart, because it's all built on the exploitation theory. And so it's all built on the idea that the capitalist exploits the surplus and expropriates it from the worker. And so therefore this is unfair for the worker, and therefore the worker should kill the capitalist, basically, is the conclusion, because he gave him a car to drive, and that's so mean. So if you carry that out to its logical conclusion, you end up with a society that destroys capital actively, because you don't want to be the guy that people want to kill because you have capital. So you take your car, you don't lend it to people to work with it. You keep it for yourself as a consumer good, and you don't invest. So you destroy the incentive to invest, which is why I think it's more than just silly and stupid, as I'm sure you know. It's really destructive and really evil.
Well, they claim that investment would be carried by either a state or in a post-state community, by community itself, but not by individual people. So at the end, they would be socializing risks, socializing entrepreneurial mistakes, and saving would be a forced saving condition, of course.
And of course, the problem here, the deeper problem, is the fact that there is no economic calculation if you don't have private property.
Yeah, for sure. That's a part of everything. But even from their perspective, they are socializing risk and socializing the need of weighing. Let's turn to Keynesianism.
Yes.
What do you think about?
Again, we could also go on for a very long time, but I'm going to pick what I view as the fundamental one. I think the fundamental error of Keynesianism is to imagine that the state of the economy, which is, I believe, a meaningless term, that the state of the economy is determined by the level of aggregate spending. And there's absolutely no good reason to believe this. And it's just something that Keynes came up with at some point, and then people continue to believe it. And so from this perspective, we have a certain level of spending that's taking place in a society between individuals and governments. They're spending certain sums. And according to the Keynesian perspective, there's a level of output. So on the one hand, we have the people that are spending, and on the other hand, we have the people that are producing. And so if the people that are spending more than what the producers are producing, then you have inflation and you have full employment. So everybody's working and we're spending so much money. So it's like you're stepping on the gas pedal of the car very fast. So the car is going faster than it should be. And so because of that, you get inflation, too much spending, or too much money chasing too few goods, in their terminology, I guess. And so too much spending causes the inflation, but you have full employment. And then on the flip side, if there's not enough spending, then you have recession and you have unemployment and you have deflation. So this is the basic premise of all Keynesian economics, and there's no escaping this. And a lot of the modern Keynesians try and make it sound like it's more sophisticated, that it's more complicated. It's not. It's really that simple. And honestly, it's that stupid. It is very stupid. There's no way around it. Because, first of all, it makes no sense to talk about the output and the level of spending, because how do you measure the output if not through the amount of purchases that are being made for the output? So to try to disaggregate those two numbers into two separate entities on its own is ridiculous. And then to pretend that you can have this magic number where you know what the value of the output should be, and to presume that the current level of spending is higher or lower based on this level that you think is the correct one, I also think is nonsensical. And the proof is in the pudding. The proof is in, we can test this. Okay, if this theory is correct, then as we were discussing earlier, the Phillips curve should hold. Then we should either have a situation where we have high inflation or high unemployment. We can't have both, and we can't have neither. And yet history is full of examples of both and neither. So this notion that we have a trade-off to do between the two, I believe is nonsensical. And I believe it's just a very silly political propaganda attempt to convince people, particularly workers, to essentially emotionally blackmail them that if you don't let us print money, then you will not have a job. And you see this today. You see, recently somebody like Larry Summers was on Twitter. He said this, and a lot of people started making fun of him. And I think that's a very good reason to make fun of him, because he was saying essentially we need more people to lose their jobs so we can fight inflation, which is criminal. You're destroying the lives of people so that you can get away with spending money. And of course that never works. And the statistics around inflation and unemployment are all already completely invalid in the way that they cook them, and still they can't manage to make the theory work.
Another school of thought, which at the end is a development of Keynesianism, but has gained some ground during the last years, modern monetary theory. What do you think of it?
I think it's an extension of the two ideas. It's kind of, you could say, it's the reductio ad absurdum of Keynesian and Marxist economics. If the quantity, from the Keynesian perspective, the money printing only matters if it exceeds the level of output. And so you need the money supply to always grow to catch up with the economy from the Keynesian perspective. And so in their mind, the increasing the money supply is good. And from the Keynesian perspective, you just don't see this idea that since the money supply is increasing, therefore the money is being devalued and people's livelihoods are being ruined because they can't store wealth for the future anymore. You don't see that anymore. And so therefore it's only a matter of time before people take that to its logical conclusion. Well, if it doesn't matter under these specific Keynesian context, then maybe it doesn't matter completely. The government just has the ability to print money. Everybody has to use the government's money. Nobody has a choice. Everybody has to pay taxes with it. So therefore, the government can print as much money as it wants. And in a sense, it works until it doesn't. And then when it doesn't, these people are forgotten. Then we get a new cycle, a new currency, and then they keep going again. So the kernel of truth in it is what makes it so destructive, which, you should think of the fact that the government can print money without consequence as being an exactly a devastating critique for why the government should not be printing money, because clearly there's no free lunch. Clearly there is a cost. The cost is being paid by somebody. So if you can't see the cost, that means the cost is piling up. And that cost is piling up through the fact that eventually the currency blows up and eventually the currency price collapses. And I think particularly, I'll just add one more thing. When you talk to some of the MMTers, you'll notice this is an ideology that's a lot more popular in the US, I think, than in many other places. Maybe even more than Europe. And maybe and definitely more than third world countries, because I think it doesn't work in the third world. Very quickly you start printing money, the currency goes to zero.
They themselves acknowledge that their theory is not working in third world countries because the state or government has not enough capacity to raise taxes.
Exactly. So how does the US get the capacity? From running the global reserve currency. So effectively what they're saying, a lot of them like to think of themselves as being leftist and anti-imperialist, but what they're saying is the US government should continue to rob the entire planet through inflation in order to hand out money to Americans, basically. And even if they're poor Americans, by global standards, the poor Americans are essentially on the top 10% of humanity in terms of their income. So you're taking money from the entire planet, which is using the dollar, in order to finance this. And the fact that it hasn't collapsed is because the whole world is very big compared to the US. So the US has an enormous amount of wealth that it can extract from the rest of the world to finance its crazy spending. So it's very sad that, the people that might think of themselves as being against the US invading Iraq, against the US running military bases all over the world and invading the world and being the world hegemon, well, that's only because of the dollar that you want to keep abusing. And if you take that away, your system doesn't work.
Many of your criticisms against those schools of thought come from the monetary side, because in some sense you are more specialized or more you have analyzed much more the monetary part of economic theory. what have been the Austrian economists that have inspired you more in the monetary theory part of economic theory?
I'd say my number one inspiration is Rothbard. I have the same T-shirt that you have. I should have gotten it today. We would have worn it together. I think Rothbard is my number one inspiration, number one person that I've learned from. I've read so much from Rothbard, and I hope to be able to finish reading every word he's written before I die, because he's such a great writer, and he communicates ideas in extreme clarity, and he has got an incredible breadth of knowledge, not just in economics. I mean, I think his work on history makes him one of the best historians of the 20th century. His work on political philosophy makes him, in my opinion, the most important political philosopher of the 20th century. And I think, of course, also I would say Mises. And I love Mises, and I've learned a lot from reading Mises, and I also enjoy reading Mises a lot. But even though Rothbard would probably tell you that Mises is a greater economist, and I'd say in terms of his impact, Mises introduced more new ideas, and a lot of it was repackaged from Rothbard. I think for our generation, Rothbard is always going to be closer, just because it's easier to read. He's writing in English, which is his first language. Mises, even when Mises wrote in English, as I've read somewhere, a very good description is that he wrote English in German. Yeah. So he thought in German, and he wrote it in English, and he wrote that almost 100 years ago, some of his books around 100 years ago. So it's not very easy for people in our generation to read it as smoothly as we read Rothbard. So I'd say Rothbard is number one, and I think he's the one that I would agree with the most. I think I have the least disagreements with Rothbard.
Another Austrian economist that you may say have some influence on you on monetary topics?
Well, of course, Hayek and Hoppe more recently. Hoppe's work probably more in terms of political philosophy than in monetary economics. Hayek with monetary economics, although I would find myself, in the disagreements between him and Rothbard, I'd say I'm more of a Rothbardian, but still, I've learned an incredible amount from Hayek's work, particularly his early work, like Monetary Nationalism and these early books that he wrote in the 1920s and 30s. Those are, I guess, the big four.
Let's talk a little bit about money, because that's also one area where I feel very comfortable. How would you define money, and what utility could you ascribe to money?
Yeah. My definition of money is the Austrian definition. Money is a medium of exchange. So it is a good that is acquired, not for the purpose of consuming it or for using it in production. So it's not a consumption good. You don't consume it. It's not a capital good. You do not use it in the production of other consumer goods. It's a good that is acquired purely to be moved on. You don't consume it. You don't produce with it. You just exchange it. So why do you acquire it? Because it solves the problem of coincidence of wants. So a medium of exchange doesn't have to be money. So a medium of exchange can be, if I'm trying to exchange something with you, you don't want what I have, but you want something else. I go and secure that other thing. That becomes a medium of exchange. But if some medium of exchange becomes generalized, where you can expect that the person you're dealing with is going to accept this thing, and people stop thinking about what is it that the other person wants, you just know that you buy from them or you sell to them with money, then with that medium of exchange, once one of these media of exchange becomes generalized, that becomes money. So the definition of medium of exchange is very precise. It's something you acquire in order to exchange. The definition of money is not precise. It's subject to your definition of generalized. So what is a generalized medium of exchange? And there's no clear answer. What's generalized for me is not what's generalized for you. So I think the definition for money can be a little bit vague, which can create a lot of confusion. But that's ultimately what money is for me. So it's the medium of exchange.
And what qualities do you think a medium of exchange has to possess in order to become generalizedly used as money?
Yeah. So here I'm, again, very much influenced by Menger, of course. Should have mentioned Menger earlier. And also Antal Fekete. First time we met was in a seminar for Fekete in Munich. And so the key concept is salability. The property that money wants is, the property that you seek money for is salability. So when you acquire the other thing as a medium of exchange, the better the medium of exchange, the more saleable it is. The more easy it is for you to find other people who are going to want it. So the way that I formulated it in this book is to try and think of salability along three different axes. There's the salability across time, salability across space, and salability across scale. From that is similar and borrowed from Fiat, although I don't quite use his exact specification, but he opened my eyes to this in a very good way. And so you want your medium of exchange, so you acquire it so that you trade it. Now, some things are just going to do the job better than others. Some things are going to work as a car better than others. Some things are going to work as a table better than others. And some things will do the job of money as a medium of exchange better than others. So you want it to be saleable across space. You want to be able to move it around. So that means you want it to be something that's likely to hold a lot of value in a small amount of weight. So it's easy to move around. So that disqualifies things like land. Because it's not, you can't move land around. It disqualifies things like houses. Then you want it to have salability across time. You want it to hold on to its value across time. So that disqualifies things like bananas and corn because these things ruin over time. And so if you didn't find the person who's going to want the banana today, tomorrow it's going to be rotten and so it's gone. So you want something that holds its value across time. And then you want something that is divisible and groupable so that smaller units can be combined into one big unit, or big units can be split into smaller units easily. So I think those are the three properties that matter. Now, what ends up happening, I think, is that with the development of industrialization, it becomes relatively trivial to solve for the problem of groupability, divisibility, and transportability. You can make things with whatever properties that you want because of modern industry. So the trickiest one is left is salability across time. And that's the one that I believe is the most critical in determining the choice of money. Particularly once over the last 1,000 years or so, we became good at making metals, and metals became very common. You could have had money in copper, iron, nickel, silver, gold, but there's a reason why gold specifically became the money. And I think that reason has to do with the salability across time. And in particular, it has to do with its ability to hold value into the future. And this is true in the case of gold because of its physical properties directly, in the sense of the physical properties of gold mean that it doesn't ruin, it doesn't corrode. If your house burns down, the gold will still be there. It's not going to burn or evaporate. You can't ruin gold in any meaningful way. But more importantly, I think the physical properties indirectly lead to what I believe is the key property of money, which is the fact that because gold is incorruptible, we are always adding on to the stockpile that we have, and we're never consuming that stockpile. So gold does not get consumed, whereas other metals, they do get consumed. They rust, they get used in machinery, they fall apart in that machinery. Whereas gold, we've been mining gold for 10,000 years now, and every year we make more gold and it just sits there looking pretty. That's all it does. So this year, all of the gold that we're mining, even though this year, we're likely going to produce more gold than any year in history, it's still only going to be something like 1 or 2% of the total gold stockpile. Because even though it's more than all the previous years, we have 6,000 years of production that have been piling up. So because of that, the ratio of the current production of gold to the existing stockpiles of gold is roughly always around 1 to 2%. And so that, in my mind, makes it the best asset at holding on to its value. Because it's the best asset at holding on to its value, the size of cash balances held in gold accumulates. And so then this gets into the salability. The salability begins to reinforce itself. So people hold it because it holds its value well. And because it holds its value well, the size of their cash balances increases. People who are holding other assets as money, their cash balance values decline. And then the predominant cash balance is in gold. And so then the smart thing to do is for you to hold gold and trade gold. And that in turn increases the size of cash balances. And so the key point here, which Fiat brings up, is that the bigger or the smaller the spread between the bid and ask, the more liquid and saleable the good is. So that for me is the causal link, that you go from having a low supply growth rate to growing cash balances to then having the highest amount of salability and lowest bid-ask spread. So that, in a practical sense, to apply that to money, that is important because if you're a very rich person, if you're a very large corporation or a government and you want to say, liquidate large amounts of money because you want to buy a company, you want to have a major expense. You want the money to be the thing where you can sell the largest quantities and have the least slippage. Historically, that has always been gold. And to an extent, it still sort of is gold, because gold is one $20 trillion liquid market all over the world. But because it's not legal to effectively bank with gold and to have banking transactions denominated in gold, that cripples gold's salability. So unfortunately today, the most saleable good is the debt of the United States government. So the US Treasury market is the real money of the world today, because if you're Norway's or Saudi Arabia's sovereign wealth fund and you want to liquidate $5 billion on a weekday, the easiest way to do it without having major slippage is to do it into the treasury market.
But the US dollar has suffered a huge cumulative inflation during its inception, but especially in the 20th century. How would you define, in this sense, inflation and deflation? Because there are some within Austrian tradition that define inflation as increasing money supply, and others refer to inflation as depreciation of the value of money. In which side would you place yourself?
I'd go with the traditional meaning of the term, which is an increase in the money supply. But generally, what I try to do is I try to just avoid using the word inflation. And I just try and it refers specifically to an increase in the money supply versus decline, an increase in prices. So to just make it clear, because it's a very long and tedious debate, within Austrians and outside of Austrians, and people are always talking about what we mean by inflation. And it's I don't like terminological debates, so I just prefer to use precise language, and I just say increase in prices.
Yeah, I was saying this because I don't like the definition of increasing money supply, because if not, we would have to say that gold is inflationary, because as you said, gold increases 1 or 2% per year, or Bitcoin is inflationary because it increases at a small rate. But obviously, the value of gold and Bitcoin have increased enormously during the last years. So when we evaluate money, as you have explained, we should take into account both money supply and money demand. I mean, do you think there can be inflationary episodes due to collapsing money demand, for instance, or just when there's a generalized increase in prices that comes from a huge increase in money supply?
I think it's an increase in the money supply, and I think the examples of collapse in demand will come as a result of an increase in money supply. So I don't think people just out of the blue decide to stop trusting a money that's trustworthy. There's probably a good reason why they stopped trusting it, because say there was inflation and they weren't able to find an alternative, then they find an alternative. So think about in inflationary countries, initially the inflation can go on for a while because people have all of their cash balances in the national currency. And so the government, a little bit of inflation gives them a significant amount of seigniorage. But then over time, as they devalue people's cash savings, you need a bigger hit, more devaluation, in order to get the same amount of seigniorage out of it. But then, of course, people start finding alternatives. And then at a certain point, foreign exchange currencies start flooding the market. And as they increase, everybody starts wanting to do them. And then, you could say, well, that was a collapse in demand. But why did demand collapse in the first place? I think it's the increase in the supply.
For instance, if, I don't know, if a government issuing a fiat money collapses, that can happen because of an invasion or just because there's an internal revolution and the government breaks.
You could also say that it happened because they issued the money in the first place. It was an increase in the supply in the first place.
Well, issue of fiat money, I mean, but...
exactly, that's the original sin.
But then you can have stable price level with fiat money, and then there's a collapse of government, and as that currency is repudiated by the government, or the government no longer exists, demand for that money collapses, and in that case you would have inflation.
It's actually interesting. That was the exact opposite of what happened in Iraq. In Iraq in 2003, when the US invaded, they bombed the central bank. So they destroyed the central bank, and the value of the currency went up. I think it used to be about 5,000 Iraqi dinars per dollar. When the central bank was destroyed, the currency went up to something like, I think it was 2,000 Iraqi dinars per dollar. So I think the demand reacts to the supply when it comes to money. People might not have the ability to react immediately and initially, but I just think, and if you destroy a government, then you make its money better.
Well, yeah, it depends on what's left after that government. So, in some sense, your ideal type of money is fixed money supply or very rigid money supply. But if money supply is fixed and there's an increased demand for money as time goes by, society will experience a deflation. Do you think deflation coming from the monetary side can have problems in terms of economic coordination, or you don't see any problem in terms of economic coordination coming from deflation?
No, I don't see any problem. I think the best example is just look at the telecom industry. You look at Apple today, the cost of the Apple iPhone that they made 10 years ago is you can buy it today for maybe $50 if you find it $10, something like that. So the price has gone from $1,000 to $10. 99% decline in the price of phones in the space of 10 years. And it's not been devastating to the tech industry. It's not been devastating to Apple. It's been great. I think it's just the normal order of things that everything should be getting cheaper in terms of money if we have economic production. Because I was saying earlier, what gets chosen as money gets chosen precisely as money, precisely because it has the lowest supply growth rate. So people choose it as money because its supply grows the least. So we're making more apples, more oranges, more phones, more computers, more cars every year. I mean, not every year. Sometimes, maybe there's a big giant problem in the orange production. But overall, you're going to be expecting that the price of all these individual goods is going to decline in terms of money, because money is because those goods are becoming more and more abundant. So the natural order is that things get cheaper over time, and that deferring consumption today should, by default, reward you with more, well, not necessarily, but should be expected to offer you more. That if you can buy a house now, but if you wait another year or two, you can buy a slightly nicer, bigger house, because your money will have become more scarce, because we're going to be making more houses from now until the next year.
But in that case, don't you think there's a difference between prices becoming cheaper because of an increase in productivity, which is at the end what you are describing, and prices getting lower because there's an increased demand for money while productivity is the same, but as money becomes relatively more scarce, given a limited supply, money is more valuable, money being the numerator of the prices, so money more valuable, prices go down. I agree completely in the scenario of rising productivity, deflation has no problem, but I don't see it so clear in the case of an increased money demand that forces a generalized deflation because money becomes more valuable. Because if every single price has to adjust at the same rhythm and in the same proportion after money becomes more valuable, not every price is equally flexible and equally adaptable to that change. So you can have changes in relative prices coming from the monetary side.
Yeah, I mean, I think it's... I think the two scenarios you mentioned are effectively equivalent in the sense that, again, the scarcity and the demand is all relative.
Okay.
So in the one situation, we have more apples and oranges. So apples and oranges become cheaper in terms of money. In the other situation, we have an increased demand to hold money. So apples and oranges become cheaper in terms of money. You could say that they're equivalent because when the supply of those things increased, you also have relatively increased demand for money. So I don't see the distinction between the two, and I don't see why it would be a problem in terms of adjusting. It's just this is going back to the Keynesian idea that prices are fixed. One of the many Keynesian fallacies that prices are not adjustable, and therefore the only way to fix things is to print money so that to make the money more plentiful to allow the prices to rise. But I don't see that would be the case, because I think we're likely going to constantly be having changes in demand for money and for all those goods. And in fact, I mean, think about the situation that would lead to an increase in demand for money. Why would that be the case? It would likely happen in the case of something like a natural disaster. So there's a natural disaster, there's a pandemic, there's an earthquake. People are not going to be spending the money that they would have spent otherwise. So let's say every week you go out with your wife to a nice restaurant. Well, if there's an earthquake, there's a pandemic, there's bad things happening, you're not going to do that. You shouldn't do that. I think, from a normative perspective, there might be tough times. You're going to need that money maybe for very much more important things over the next couple of years. So you skip the dinner, you skip the nice new car that you wanted to buy, you reduce your demand for those things. And that, I believe, is how the hard money economy adjusts to a crisis, because it gives everybody who's holding money added purchasing power for their money. And then it makes the fewer resources that we have, because, we had an earthquake. So now instead of buying all the apples that you usually buy, you buy only the apples that you really need. You're a lot more careful. And that makes more apples available for people who were impacted by the disaster. And it makes the money in the hands of the people that were impacted by the disaster more valuable. So I don't see it as, again, with all of those things, I see it from the Austrian perspective, where it is the market is the sum of the voluntary actions of individuals. And so at no point do I take the Keynesian pill of putting myself in a position of saying, no, the voluntary actions of individuals in this case is not optimal by my standard. And therefore, from the Keynesian perspective, usually you want to introduce some kind of coercive measure in order to try and prove this.
One related question emerging from this, and I will continue afterwards with money topics. Do you think we can talk about market failures, or that terminology is a nonsense, even if we study market failures as problems, economic coordination problems within market?
Yeah, no, I think the term market failure, the way that is used in economics, I discuss it in chapter 17 in my book. I think ultimately it's only tenable in a world in which you, as an economist, give yourself the right to pass judgment on people's valuations. So you decide that people with their own money deciding to spend their money on A, B, C leads to an outcome where society produces too much A and not enough B and just the right amount of C. So therefore we need to tax A in order to subsidize B so that we can have more B and less A. But this just means that your value judgment supersedes the value judgment of others. In all of these forms of market failure, when people are crying about voluntary transactions between people leading to outcomes that they don't like, in all these situations, the fact that you don't like it just means that you have a different value system, that you have a different valuation of those things. And I don't believe that being an economist qualifies you to
social engineer.
Yeah, you can't be a social engineer, and you can't tell people what they should value. You think people shouldn't be spending money on football, they should be spending money on schools. Okay, go spend your own money on schools, but you can't take people's money and tell them you can't put it on
or try to persuade people to spend otherwise.
Exactly. You can try to spread,
Okay. Although I think there's some room to speak about possible coordination failures within markets. Another issue is whether the government can solve those coordination
of course,
failures.
Coordination failures, of course, happen. But, there are ways in which people voluntarily can solve them. So,
from the market and from the institutions emerging from the market.
Exactly.
Going back to the monetary topic, because another very interesting debate within the Austrian school is the debate on banking, whether we should have 100% reserve banking or fractional reserve banking. There are some economists, for instance, here in Spain, Jesus Huerta de Soto, which is my director in my PhD thesis, or, you have mentioned before, Hans-Hermann Hoppe, Joe Salerno, Guido Hulsmann, who are in favor of 100% requirement. And then we have other economists, like George Selgin or Larry White, that they think it's enough with free banking, even without fractional reserve. And we could name a third group, which is the one in which I place myself, which is the Antal-Fekete school of tradition, that is more favorable to a free market in banking, but with real world doctrines. But that's another issue. What's your perspective on this?
My perspective is that in terms of a policy prescription, I don't believe that there should be any kind of governmental intervention in this. So perhaps I may disagree slightly with De Soto in that he thinks it should be prohibited as fraud. I'm not so sure that I go that far, but I would say that I would support free banking in that you should be free to do all of those things if you want to engage in fractional reserve banking. And you do it transparently with others. I'm familiar with his argument for fraud, but I'm willing to concede that argument because I don't think you need it. Because I think if you do truly have a system in which there is a free market and there's no monopoly and there are no restrictions on opening banks and there are no restrictions on moving money in and out of a geographic location, then I don't think fractional reserve banking would survive. This is my view. So it's essentially the idea that what you're doing with fractional reserve banking is effectively increasing the money supply without having mined new gold. So what the bank is doing is using its monopoly or relative monopolization of banking clearance rails in order to enforce a monopoly on its, in order to increase the value of its liabilities beyond the reserves and assets that it has on hand. So whether you want to say that that is legal or illegal or fraudulent or not, I leave that to the lawyers and the jurists. But I think of it from an economic perspective, if you let that stuff happen in a free market, I don't see how it survives. And I think all the examples that we have of fractional reserve banking surviving and succeeding have always involved a very high degree of monopolization. And I think if we look at 19th century banking in general, just because of the limitations of technology at that time, there were banking monopolies. So if you were in the city, I presume, back then in Madrid, 200 years ago, I don't think there were so many banks in Madrid. And I don't think there were that many banks that were able to move money from Madrid to Barcelona to Paris to London. So at the end of the day, there's a couple of banks. And then if those 2 or 3 or 5 banks get together and say, we're going to do, say, 10% increase beyond our reserves, then their bills can all... if all of them are becoming 10% less gold, then the value among themselves is indistinguishable. If one of them breaks out of that monopoly and keeps the hard money, it's conceivable that I think over time people are going to, the value of the other paper bills issued by the other banks would decline. So they would go down in value and that one would appreciate. And I think over time, the business of the currency that is fully backed will drive out the other ones. But if you have monopolization and collision between those, then I think it's feasible to keep this. But even then, in the 19th century, you had all these business cycles and all these crashes because of this credit expansion that monopoly banks could do. And then the only way that this was allowed to be made sustainable was through the establishment of central banks. So in the US, they continue to have all these business cycles. And, for me, the solution would have been they should have had more of this until people who try this all lose their money and then nobody tries it. But instead they said, okay, how about we force everybody to use our money so that then the ones who try it get bailed out by the ones who don't try it. So for the last 110 years, 12 years, we've had a system that taxes full reserve banks effectively, punishes them in order to reward fractional reserve banks. So I don't think it's something that would survive on the free market.
Even if those fractional reserve banks followed rules of managing in a responsible way their assets, in covering liabilities with liquid assets that can be converted in the very short run into money, for instance, real bills, but not necessarily real bills, similar types of assets, you don't see any type of advantage in that kind of banking over full reserve banking, because full reserve banking is also costly. I mean, having gold stored in the bank, surveilled, insured, etc., has a cost. Maybe
it's a lot cheaper than inflation.
But I don't know whether the other type of banking would be necessarily inflationary, in the sense that if you keep if we define increasing money supply as inflation, sure. But as a price increase, if you keep the liability issuance by the bank connected to real production, let's say, when goods reach the market, you monetize the value of of those goods. because that's the real bill. Then, okay, you have an increase in money supply or money substitutes, but also an increase in the goods that are going to be sold against those money substitutes. And if those goods are not sold, the bank goes into bankruptcy and those money substitutes collapse, of course, because those are the liabilities of the bank. So what I'm saying is full reserve banking has advantages, but it has also costs, and fractional reserve banking has also advantages and costs and risks. Maybe they can coexist in a market, and some people is more willing to take risks and in exchange of a less cost money supply, money provision, and others not.
Yeah, but I don't think that, I mean, so you can, let's say a group of people want to decide to do this. They want to accept the liabilities of the bank at face value, even though the bank doesn't have full reserves to back it. I don't see why that would trade on the market at par with liabilities of a bank that has full reserves. So I think in a free market, I have a bank that has, that sells you 1 ounce bills, and you can redeem it for 1 ounce of gold. I think what it comes down to is, if you really want to be sure that you can always, that you will never go bankrupt, the only way is that for every single paper, you will have 1 ounce of gold in reserve. You don't have goods that you could sell, because then maybe you can't sell them at that time. You take the gold, you hold the gold, and you distribute the money for it. And then that's the only way that you're able to meet all of your liabilities unconditionally. And I think ultimately in a free market, I think the way that I would see it is that there would be exchange houses where people, banks and all kinds of institutions that take money, maybe even shopping malls that take money from different kinds of people. So let's say we live, imagine we live in a world in which we say have the dollar as the currency, but there's no central bank. Private banks issue dollars, and the dollar is defined as, let's say, 1 ounce of gold. And so everybody has a dollar bill. This is the Citibank dollar, the JP Morgan dollar, the Goldman Sachs dollar. But if one of these banks decides to increase the amount of dollars that they have in circulation, then the price of that bill is going to decline in the market. The exchange shops, they're going to start finding that they're getting a surplus of that. And so they're going to start discounting it in terms of its value compared to the others, because there's an increase in the supply. Just like you see in the foreign exchange market now, the central bank prints money, and people don't know that the central bank prints money, but suddenly the price of the money begins to decline. Why? Because people are just getting so much of it, and they want to try and get rid of it.
But I wanted to ask about this later, but as I think it fits better now, what's your perspective on Tether? Because we have not yet talked about Bitcoin and crypto world, but I think it's a good example to think of. Why? Because Tether more or less is quoted at par with the US dollar, but Tether doesn't have full reserve banking in dollars. Actually, they are investing in short-term dollar assets, and there's no bank run, or there have been bank runs against Tether, but they have, at least until now, they have survived to all of them. So do you think that Tether is gonna disappear at some point, or that business model can be sustainable?
Well, the thing is, you remember when we were saying what is money today, I think, and I remember I mentioned it was the US government debt that is really money. And you could think of the dollar as being a derivative of the treasury, more than the treasury being the derivative of the dollar, because the treasury market is much more liquid than the dollar market. So in that sense, I think you could say that holding treasury bills is the
full
fiat,
reserve,
is the fiat equivalent to full reserve. And in that case, I think it's absolutely astounding that Tether have grown to the extent that they are at. I think they're now at $130 billion, which is just mind-boggling. Because, I remember when it first came about, and initially I was extremely skeptical, and I thought, just another one of these crypto coins, and one day the government is going to shut them down. One day it's going to fall apart. One day they're going to run away with it. But it was in 2022, remember, in 2.5 years ago, when there was the big crash in Bitcoin. And at that point, I think, I had the CTO, Paolo Arduino, on my podcast. I discussed it with him. And he gave me the numbers, exact numbers of how much they had to redeem. And it's absolutely mind-blowing. They redeemed, I can't remember, but I think it was over a weekend, something like $10 billion.
Yeah, or more, yeah.
And just trying to imagine, I mean, if you go to the JP Morgan and you ask them for $10 billion in a weekend, the entire US banking system will probably collapse. I mean, the central bank will probably put you in a room and shut you up and put a gun to your head and tell you, shh, don't tell anyone. And we're going to see what we can do. And we're going to try and keep this. And they're going to have to go crazy. And yet for Tether, they just clicked a bunch of buttons, sent a bunch of dollars to the exchanges, and everybody got their Bitcoin, everybody got their Tether redeemed. So I found it absolutely astounding, but I think it is an example of full reserve banking.
Okay. You have said that currently the US Treasury are our money standard today. Can you tell us a little bit more about the fiat money standard we are in? Has it some advantage? What are the disadvantages or most important disadvantages that we are suffering about?
Yeah, so that was my second book, the fiat standard. I tried to analyze the fiat monetary system as if it was a digital currency, thinking about it because I think, software clarifies things. When you're trying to understand what's happening with fiat money, there's a lot of propaganda, there's a lot of emotions, there's a lot of trying to hoodwink you with nationalism and making you feel emotional about this currency. But, software gets rid of all the emotion. So trying to analyze it just by drawing analogy with Bitcoin, I think is very, very instructive. The key insight that I could think of in terms of the fiat system is that in Bitcoin you mine Bitcoin through the proof of work. With gold, you mine gold by digging in. Well, in fiat, you don't actually make more fiat money by printing the dollars. The printing happens after the dollars have already been created digitally. But how do the dollars get created digitally on people's balance sheets? Through lending. So fiat money is created through lending. So this was really a very eye-opening realization when you realize that in the fiat monetary system, every time somebody takes out a loan from a bank that is connected to the central bank, new money is created. So more money is added onto the money supply. And this therefore means that there is a huge incentive for people to create debt. And that then makes sense. That makes sense out of why everybody everywhere is in debt. Governments get into debt, individuals get into debt, corporations have to run on debt. And it's always something that everybody finds odd. I remember when you're growing up as a child, how is it that this guy's in debt and this guy's in debt and everybody's in debt and the government is in debt? Who are we owing money to? Like, who's lending all of those people? How are they all borrowing if everybody's in debt? And the answer is they're borrowing from the future, because that's what the fiat money does. It allows you to create money today, and effectively you have to pay for it later on into the future. So everybody's borrowing from their future self. But it makes sense to borrow from your future self, even though there's a big problem in terms of taking on debt. There's a risk. You could lose your collateral. You could end up on the street if you're doing it. But it does make economic sense in the fiat system because it's creating money. So if you're trying to save money in order to buy a house, as you're saving the money, the value of the money is declining and the price of the house is going up. You'll never be able to catch up. On the other hand, if you borrow today and you pay for the house over 30 years, you've bought the house today with today's money, and then the price of the house is, as you're paying, is going to be declining because you're paying in a declining currency. So unfortunately, it makes sense for everybody to get into debt, and that's, I think, kind of depressing because before I wrote that book, I was one of the people that used to think, I don't want to get into debt. Debt is a scam. Then you understand why it makes sense because it's really just making more money. So the consequences of that have been devastating. And in the fiat standard I discuss in detail, I think the most important one for me is the impact of the reduction in the value of money and the increase in the supply on people's time preference. As the money supply increases, the amount of certainty that you have about the future becomes less. As you expect your money to decline in value more, your ability to provide for your future declines. So the future becomes less certain for you, more uncertain. And therefore you become more likely to think of the present at the expense of the future. And that's the opposite of the process of civilization. As Hoppe describes it, the process of civilization is the lowering of our time preference. When we start thinking about the future, we delay gratification, we start accumulating savings, we accumulate capital, we produce for the future. So it's, in my opinion, it's no exaggeration to say that moving off gold to fiat money is reversing the process of civilization. It really is quite literally reversing the process of civilization, because the process of civilization is inextricably linked to money and to our ability to think of the future and provide for the future. And I get into all kinds of details about it and about the implications of this. People can't save, people have to get into debt, things continue to get more and more expensive. And of course, the flip side of this is that government has an enormous amount of power to then shape society as it wants, because it's taking away all of the money that you can't provide for your future self. They're taking away, and they can spend it on all kinds of crazy things.
Yeah, because at the end, fiat money is funding the government. So, but if fiat money has all those features that go against at the end to civilization, would you replace fiat money? And in that case, what would be the alternative?
Well, I think, the obvious alternative for me used to be gold, because I thought that would be the thing that would work best. And so I used to be a gold bug, and I used to think that the answer is to go off fiat and go off gold. And you keep thinking that, fiat money is going to collapse and then we're going to replace it with gold. But after a few years of thinking like that, eventually, I think I started to change my opinions a little bit, because I've begun to accept the bitter, hard to swallow truth that the fact that gold can be deactivated effectively monetarily by government is a feature. It's just, we have to accept that this is how it is. It's just, as long as governments, in my opinion, as long as governments can maintain a monopoly on banking, and they maintain a monopoly on international transfers, and they maintain a monopoly on which institutions are allowed to function as banks, then you can't monetize gold. And that's why I think gold bugs can be disappointed frequently and can continue to get disappointed, because it's not going to monetize and it's not going to be used as money unless people are able to use it for trade. And in today's world, trade is increasingly global. So we can't use it just because it's physical. I mean, there's something nice about the idea that you hold the money in your hand and it makes a sound when you drop it, and you can pay somebody. It is nice. But the vast majority of your transactions today are being conducted by people that are not at arm's reach. You're paying for your groceries to a supermarket that's a half an hour away. You're not going to send them the coin. You do it over digital payment systems. So because of that, you need a centralized system that clears and moves the gold around. And that's always going to be vulnerable for governments. And governments have figured out how to take over. And it's been a whole century that they have effectively deactivated it, and I think we need to come to terms with that. So we've got a solution for that. Before I found Bitcoin, I was one of the people that are constantly complaining and being angry and bitter about it. And you find Bitcoin and you find Zen, because that's it. We no longer need to complain. We no longer need to demand people do things. We no longer need to ask them to vote for Ron Paul or vote for this guy. It doesn't matter now. You can have your money that crosses borders, that doesn't need to be centralized, that doesn't need to go through government institutions. And I believe that's why Bitcoin has been monetizing, and that's why its market capitalization has been growing. The size of cash balances in Bitcoin have been growing. It's gone from $0 to $2 trillion in the space of only 15 years. So I think because of that, it's going to likely continue to do that. And I think as the size of cash balances grow, remember the dynamic we were mentioning earlier about how store of value, the ability to store value translates into larger cash balances. We're seeing that with Bitcoin, but we're seeing it happening at a very fast rate. So if it continues to happen another 10, 20, 30 years, who knows, the size of Bitcoin cash balances, I think, are going to become the largest cash balances in the world, at which point it becomes the most saleable good, at which point it has the lowest bid-ask spread, and at which point, basically, we're free.
But for that point to arrive, the volatility of the price of Bitcoin would have to stabilize, because otherwise it will be very difficult to use it as a unit of exchange, since economic calculation cannot be well done if you have a numerator which is very volatile. So you think that once the monetary balances of people are increasing with Bitcoin, the value will tend to stabilize, or that?
Yeah. Because I think as the size of the cash balances in Bitcoin increases, the bid and ask spread declines.
Okay.
And so, think about a few years ago when Elon Musk first got into Bitcoin. He announces that he's getting into Bitcoin. Immediately, the price goes up something like 20% or 10% or something like that in a couple of hours. The richest man in the world buys some Bitcoin, the price jumps up. But since then, Bitcoin has doubled or tripled in its value. So now, if Elon Musk was to do the same thing, if Jeff Bezos was to do the same thing, it would likely have a smaller impact. Now, give it another 10x, it'll be an even smaller impact. So you want to grow this liquidity. You want to grow the size of cash balances so that the size of transactions that are always taking place is enormous, so that there's an enormous depth of transactions, so that if somebody makes a giant sell order, then that sell order can be eaten up relatively quickly, because the price only needs to decline a little bit and then you get a lot of buy orders in exchange, because there's a lot of people buying and there's a lot of depth in the market. So as the size of the cash balances increases, I believe the liquidity is likely to decline. We're still, even up until this point, I think we're basically a rounding error compared to global cash balances. Because if you think about what we think of cash balances, you could say all of the global fiat monies, which add up to around $100 trillion. And then you have a government bonds, which are also about another $100 trillion. And then you could add gold, and probably, depends on how you think of it. You could make a case that some of real estate and some of the stocks, particularly stock index.
Also art.
Art, exactly. These are essentially used as cash balances. A lot of people are, buying stocks not because they've read the balance sheet of the company and they're making an informed investment that they believe this is going to have more earnings per share than the other company. They're just looking to beat inflation, and they want something that beats inflation. So you add all of these up: 100 million in fiat, 100 million in government bonds, 20 million in gold, and then some rounding errors not rounding errors, they're significant in real estate and art and the stocks. You're talking $300 trillion or so. 200 to 300, I think, is a good estimate. So we're at 1% of that. So we've just hit 1% after 15 years of Bitcoin. So it's still a rounding error compared to that. But if Bitcoin's 20 trillion, then I think it becomes a significant part of it. And I think Bitcoin has another advantage, which gold has, but treasuries don't have, which is that it's one fungible good. It's just one same thing. There's only one Bitcoin. Whereas with treasuries, it's a very deep market, but there are all kinds of different maturities. So there's no guarantee that when you're trying to sell the 5-year, you will find somebody who wants to buy the 5-year. So Bitcoin has that advantage, which is, what the market would choose, why the market chose gold, and gold is fungible. So I think this means that Bitcoin has this extra advantage. So for me, you could say that when Bitcoin hits 25, 30 trillion, in current terms, because that's the size of the US Treasury bond market, then it becomes the most liquid asset in the world. So yes, there are many other fiats and there are many other assets, but Bitcoin is the biggest one. So you could maybe make a case that once it gets to that point, then it starts to grow very quickly, because it establishes the lead, and then it just becomes the leader. But I think, as it grows, imagine if Bitcoin was $300 trillion, then I don't see that it would have this volatility. And I think the best way to look at this is look at gold. How is it that gold achieved this incredible level of low volatility? You can't really say it's stable, because nothing is stable in economics. But if you look at the price of a cow throughout history, it's been remarkably constant in gold. It fluctuates, but it fluctuates a little bit. So how did that happen? We don't have a central bank that's managing the supply of gold. It's happened because gold built the largest cash balance.
How do you envision the financial system in case we arrive at a scenario where Bitcoin is the standard? Because you said that with fiat, people is pushed to go into debt, and that everyone is indebted. But how things would change in case Bitcoin was the standard?
I think, as you mentioned, the fiat system drives us toward more and more debt. So Bitcoin would be the opposite. I think you take away the incentive for money creation, for lending through, because of money creation. So then you're going to end up with a lot less money creation through lending, and a lot less lending. And even if you do have lending, it won't be creating money. And then I think the other thing is, and this is a paper that I've presented recently at the Property and Freedom Society with Professor Hoppe, I think you would expect that because we have a hard money and everybody's able to accumulate this money and everybody's able to have savings, then you'd see cash balances increase and you would see that people's time preference would decline. So people begin to save more, which makes them more and more future oriented, which would cause interest rates to drop. And so, Hoppe talks about this, and also there's a great book by Homer and Scylla called A History of Interest Rate, or The History of Interest Rates. And they look at 5,000 years of his interest rates. And they show that generally there has been a long-term trend of interest rates declining, which I think is a really interesting thing. In my view, it's a measure of human civilizational progress. As we become more civilized, we accumulate more capital, we lower our time preference, capital becomes more abundant, so capital becomes cheaper. So my controversial idea is that it's going to continue to become cheaper, so interest rate will continue to decline further and further and further. At a certain point, the interest rate becomes lower than the cost of storing money, because there's always a cost for holding money, both in terms of the physical security of the money, but also in terms of the risk of it being stolen or the cost of insuring it. So at a certain point, when capital is so abundant, the interest rate drops to a point where getting a nominal 0% return on your interest, on your loan, is a real positive return, because it saves you from the cost of storage, and it transfers the liability for the money to the borrower. And also, in real terms, it's positive because it's appreciating over time in real terms. So I think we'd have a world in which capital becomes incredibly abundant. And, maybe you might not agree with me that we go all the way to zero, but I think the case for it declining steadily is, I believe, very solid.
And just one final question. You said before that you no longer see gold as a replacement for fiat currency because governments have a large power over gold and they can manipulate gold. But it's also happening that governments are getting more involved in Bitcoin. Actually, one of the promises of Trump has been to build a strategic reserve of Bitcoin that would confer the US government some ability to manipulate the price of Bitcoin if they desire to. How do you see these promises? Do you think they are confirming Bitcoin as future money, or you see them as threats to Bitcoin as becoming money?
I don't really see it as a threat to Bitcoin. I think because with Bitcoin, as long as the governments can't stop people from using it, then I don't think that they can manipulate it. Because ultimately, if the US government buys 2 million Bitcoin, I mean, they manipulate it in the sense that if you buy it, you're going to bring the price up. And then if they sell, they're manipulating it by bringing the price down. But, I also manipulate it every time I buy and sell. So Bitcoin, because nobody can print it and nobody can make more of it, that nobody can make fake Bitcoin to put on the network. I don't believe anybody can manipulate it. I don't think it's possible. All you can do is buy Bitcoin or sell Bitcoin. And that's not manipulation in a sense, because it's a market decision. You're deciding that you're getting rid of the Bitcoin, or you're deciding that you're holding it. So in that sense, I don't really see them being able to manipulate it. I see them, if you're not a fan of the US government, then you might not like it because you wouldn't want the US government to have a lot of power. But I guess there's also the case to be made that if the US government moves on to a Bitcoin standard, if they start accumulating more and more Bitcoin, rather than continuing to use the dollar, well, then that takes away, that makes the dollar, it makes the Bitcoin appreciate, makes the dollar depreciate, and it takes away from their ability to finance themselves with inflation. So I would say that would be a good thing. I think if you can make the world's governments become fiscally responsible because they're using a neutral monetary asset that they cannot print, I believe this is going to be an enormous benefit to the world in terms of freedom.
But you don't see the US government giving up voluntarily the dominance of the US dollar?
No, but if they buy a couple of million Bitcoins, I mean, it's a very, very strong signal to the world that, hey, we don't really think this dollar thing is going to be around for a very long time, right? Because, look, the US government is maybe the only government within a fiat system. If you believe in the sustainability of the fiat monetary system, then you would think that the US government is the only government that shouldn't buy Bitcoin, because let's say you get Bitcoin, it's going to go up. Well, what's the point for the US government to buy Bitcoin when it goes up? Let's say they put $100 billion into Bitcoin tomorrow, And then next year, it goes up by 100%. So now they have $200 billion. Great. So what are they going to do with the $200 billion of Bitcoin? Sell it for what? For dollars? They can print dollars. But if it goes down, then it's going to be politically very unpopular. So it might seem like it doesn't make sense in the short term. It makes sense in the long term, which is we realize eventually the world is not going to continue to use our dollar forever. And the next best thing is going to be Bitcoin. So let's steal a march onto Bitcoin so that if, it's a very, very smart move. And if the world is going to take away the dollar from us, they can only do it by buying Bitcoin. But if we've got 10% of the world's Bitcoin, then we're going to be sorted. And I think, that would put the US government in a good position, but it would still have to teach it financial responsibility and fiscal responsibility. Even if they have 10% of the world's Bitcoin, they need to be financially responsible because they can't print it.
Totally.
So if they start being irresponsible, they won't have 10% anymore. So this would, I believe, be a win for world freedom, even if it's you don't want your enemies to have it, but that's the whole point of Bitcoin. You can't stop them, just like you can't stop you. That's the flip side.
Thank you very much, Saifedean, for
Thank you.
this very interesting conversation. It has been a pleasure to have you here.
Thank you. It's a pleasure and an honor to talk to you. I've followed you for a long time, and I really, really salute you for all the great work that you're doing. Thank you so much for bringing these ideas to the world. Thanks.
Thank you very much. And thank you very much to all the audience for following us in this new episode in our podcast with Saifedean Ammous, author of several books, the last one here with Deusto. Thank you very much and see you later.